हेलो फ्यूचर सीएज एंड वेलकम बैक टू आवर सीए मेड इजी सीरीज। आज हम एक बहुत ही क्रूशियल और सच में फैसिनेटिंग टॉपिक डिकोड करेंगे। वी आर लुकिंग एट द 1991 इकोनॉमिक रिफॉर्म्स। सो दिस इज पार्ट 2 ऑफ चैप्टर 10। अगर आपने हमारा पार्ट 1 देखा है तो आपको याद होगा कि हमने प्री और पोस्ट इंडिपेंडेंस एरास को डिटेल में कवर किया था। आज वी गोना डाइव डीप इनटू द वेरी रिफॉर्म्स दैट कंप्लीटली चेंज्ड द डीएनए ऑफ द इंडियन इकोनॉमी। So grab your notebooks. We are focusing purely on in-depth conceptual clarity, exactly as per your ICAI syllabus, and we'll be using plenty of real-world scenarios to make sense of it all. Let's jump right into this explainer.
Here's a quick look at our agenda for today. We'll start by contrasting the old state planning with the 1991 crisis, then we'll decode the fiscal reforms. Move on to monetary and financial reforms, check out capital market reforms, and finally, look at the impact on modern business.
All right, let's hit our first section, state planning versus the 1991 crisis.
You know, to really appreciate the cure, you first have to understand the disease. What was the exact situation that forced India to completely flip its economic model in 1991? Well, pre-1991, India followed a strict state-led planning model. Pehle, the government basically controlled everything. We had this notorious system called the license Raj. If you wanted to start a business or even just produce a little extra in your existing factory, you had to navigate endless bureaucratic permissions. Private investments were actively discouraged, and our trade policy was completely inward-oriented. Essentially, our economy was closed off from the world and strangled by heavy regulations. The 1991 paradigm shift reversed all of this. It was a massive radical pivot towards a market-oriented economy that actually welcomed private participation and opened up borders to global trade. लेकिन ये sudden shift हुआ क्यों?
It happened because we hit absolute rock bottom, represented by this terrifying number, $1.2 billion. By 1991, India's foreign exchange reserves had crashed to this level. To put that into perspective, ये amount सिर्फ 2 हफ्ते के essential imports cover करने के लिए काफी था. Just imagine, a country of our massive size could only afford to buy essential things like oil for 2 more weeks. We were literally on the brink of an international default. The crisis was incredibly severe, which meant the medicine needed to be equally strong.
So, the government had to act fast. They rolled out something called macroeconomic stabilization. Conceptually समझते हैं इसको. Think of it as the immediate, short-term first aid given to a heavily bleeding economy. The primary goals here were absolutely critical. Control the skyrocketing inflation, fix the immediate adverse balance of payments crisis so we didn't default, and bring down the massive fiscal deficit. It was pure survival mode at this stage.
Which brings us to the first major pillar of these reforms. Let's decode the fiscal reforms. Yani ki, the government figuring out how to fix its own wallet. Before we go further, let's make sure our foundation on fiscal deficit is crystal clear. Think of a normal household budget. जब आपके घर का खर्चा आपकी monthly salary से consistently ज़्यादा होने लगे, तो आप क्या करेंगे? Obviously, you'll borrow money, right? Maybe max out a credit card. That is exactly what a fiscal deficit is for a country. The government's revenue expenditure was consistently exceeding its revenue receipts. To survive, they were piling on mountains of domestic and external debt. Eventually, just paying the interest on that debt became an unmanageable burden.
So, what radical steps did they take to fix this massive hole in their pocket? First, they needed to boost their income. So they introduced a stable, more transparent tax structure to ensure better compliance. Log tax accurately देंगे, तभी तो revenue आएगा, right? Second, they had to cut up those metaphorical credit cards. That meant strictly curbing government expenditure and drastically reducing unnecessary subsidies. And third, they made a very bold move: disinvestment. The government actually started selling parts of its equity in select public sector undertakings. This brought in much-needed immediate cash and signaled a welcome to the private sector.
And here is a really fascinating milestone that showed they were actually serious about financial discipline. In September 1994, a historic agreement was signed between the government and the Reserve Bank of India. क्यों ज़रूरी था ये? Because historically, whenever the government ran out of money, they took the easy way out and just asked the RBI to print more, which fueled inflation. This new agreement aimed to phase down the fiscal deficit to nil by 1997-98. It was a huge structural shift. It essentially meant that the government couldn't just treat the RBI as its personal ATM anymore.
Okay, so the government's wallet was slowly getting fixed. Next, it was time to look at the heartbeat of the economy. Let's jump into monetary and financial sector reforms.
To really get this, imagine the pre-1991 banking sector as a runner forced to wear heavy iron chains. Pre-reform, banks had incredibly high reserve requirements. specifically CRR and SLR. This literally meant most of a bank's money was locked up with the RBI, leaving them very little actual cash to lend out to businesses. On top of that, interest rates were strictly dictated by the government, and public sector banks enjoyed a complete, lazy monopoly. Post-reform, largely guided by the famous Narasimham Committee recommendations, these chains were finally taken off. CRR and SLR were significantly reduced, interest rates were deregulated so the market could decide, and most importantly, the doors were flung open for private and foreign banks to enter the competition.
Let's think about a real-world scenario from the 1980s. Imagine a hardworking businessman trying to get a standard loan. He'd wait months dealing with frustrating red tape at a monopolistic public sector bank that had no incentive to help him quickly. Post-1991, with new private players entering, these banks suddenly had to compete. They started offering that same businessman better rates, faster service, and actual customer care. But, and this is crucial for you as future chartered accountants, with this new freedom came very strict responsibility. The reforms introduced prudential norms of accounting. Extremely strict rules were applied for classifying assets and making mandatory provisions for bad debts, or NPAs. The RBI stepped in and ensured that a commercial bank's books finally reflected an accurate, truthful financial picture. The days of hiding bad loans under the rug were over.
So the banking sector was breathing easier. But bank loans are not the only way to fund a company's growth. Let's move to our third pillar, reforms in the capital markets.
I want you to pause and really think about this question. लेकिन नए businesses को massive scale पर grow करने के लिए capital आएगा कहाँ से? Bank loans have limits. For a country to truly industrialize, businesses need to raise equity. They need the common public to invest their savings into the stock market. But here's the catch. The public will only hand over their hard-earned money if they actually feel safe and trust the system.
And that is exactly where our market referee enters the pitch. SEBI, the Securities and Exchange Board of India. Now, while it was initially set up as a non-statutory body back in 1988, the true game-changing reform happened when it was granted statutory recognition in 1992. It finally became the powerful, independent regulator that our wild, unpredictable capital markets desperately needed.
SEBI's core mandate was super clear: create a transparent environment. अगर market transparent होगा और rules सबके लिए equal और clear होंगे, तो investor trust करेगा. And that trust was the exact fuel needed. It facilitated the massive mobilization of resources. Ordinary retail investors finally felt confident putting their savings into shares and mutual funds. This, in turn, efficiently allocated capital right into the hands of the modern businesses that needed it to build factories, hire people, and grow the economy.
Okay, we've unpacked the government's fiscal fixes, the banking liberation, and the new capital market rules. Let's tie all these threads together. What was the ultimate impact on modern Indian business?
Let's look at the sheer operational freedom businesses suddenly got. Under the old license Raj, large successful firms were actually punished for growing. They were choked by the MRTP Act, facing intense pre-entry scrutiny and strict capacity limits. अगर आपको अपनी खुद की फैक्ट्री में प्रोडक्शन बढ़ानी थी, तो पहले लंबा चौड़ा परमिशन लो. But the new industrial policy announced in July 1991 was like a breath of fresh air. It abolished licensing for a whopping 80% of the industry. Those restrictive MRTP provisions, gone. Furthermore, the concept of automatic approval was introduced for foreign direct investment up to 51%. Foreign capital and advanced technology could finally flow into India without hitting a brick wall of bureaucracy.
And when we talk about global integration, just look at these staggering numbers. In 1990-91, the highest import tariff rate in India was an absolutely mind-boggling 355%. Imagine you're a manufacturer trying to import an essential, high-tech machine, and you have to pay 3.5 times its actual price just in taxes. By aggressively slashing tariffs, it dropped to 85% by 93-94, and all the way down to a much more normal 10% by 2007-08. This external trade liberalization didn't just make imports cheaper, it forced Indian domestic industries to step up, improve their quality, and compete on a global scale.
So what is the big takeaway for you from all of this? The compounding, long-term results of these structural reforms were nothing short of phenomenal. We witnessed unprecedented, explosive growth in private sector investments. Indian sectors like IT, software, and pharmaceuticals didn't just survive, they achieved massive international competitiveness. And hey, remember that terrifying $1.2 billion figure from 1991 where we only had 2 weeks of imports left? Today, our robust foreign exchange reserves comfortably cover nearly 8 months of imports. The 1991 reforms truly took a bankrupt, suffocating economy and transformed it into a globally competitive powerhouse.
Which leaves us with a very provocative thought to end on. The 1991 reforms were born out of absolute desperation. Our backs were against the wall. Today, as India stands tall, highly integrated globally, and armed with deep financial markets, I want you to think critically as future financial leaders. Will the next major wave of macroeconomic reforms happen proactively because we want to improve? Or will human nature dictate that it requires another severe crisis to force our hand? Ponder over that as you prepare for your exams. Thank you so much for joining me today for this explainer. Keep studying, keep focusing on these core concepts, and I'll see you in the next one.